Imagine turning pocket change into a financial powerhouse. Sounds impossible, right? But hold on, aspiring investors, because even the legendary Warren Buffett started small. Contrary to popular belief, you don't need millions to begin your investment journey. With a sprinkle of Buffett wisdom and a dash of strategic planning, even tiny sums can blossom into impressive returns. So grab your piggy bank, dust off your dreams, and let's dive into the world of Buffett-style investing for the little guy. Rule 1. Think long-term, not lunch money. Warren Buffett, the Oracle of Omaha, has built his legendary investment success on a foundation of patience and long-term thinking. He often quips, "The stock market is designed to transfer money from the active to the patient." This succinctly captures the essence of his first rule: thinking long-term, not lunch money. Buffett urges investors to discard the allure of get-rich-quick schemes in favor of a patient and strategic approach. He likens investments to seeds planted today, with the expectation of reaping a bountiful harvest in the years to come. In his words, the best time to plant a tree was 20 years ago. The second best time is now. This philosophy encourages individuals to focus on companies with solid fundamentals and the potential for sustainable growth. The analogy of building a financial castle, brick by brick, as opposed to a sandcastle washed away by the next tide, paints a vivid picture of the importance of resilience and permanence in investment decisions. Buffett's wisdom lies not in chasing short-term fluctuations, but in constructing a fortress that can withstand the tests of time and market volatility. Rule 2. Knowledge is power and doesn't cost a dime. Buffett's second rule emphasizes the significance of knowledge in the world of investing. He once said, "Risk comes from not knowing what you're doing." This statement underscores the idea that informed decisions are the bedrock of successful investing. Educating oneself is crucial, akin to knowing your spices before entering a cooking competition. In the realm of finance, Buffett encourages individuals to read books, articles, and listen to financial podcasts. He understands that knowledge is the most valuable asset and reassures investors that it is readily available. Buffett's emphasis on continuous learning aligns with the accessibility of free online resources. Investment simulations and stock market simulators allow individuals to practice their skills without risking real money, providing a valuable platform for honing investment acumen. As Buffett aptly puts it, "The more you learn, the more you earn." Rule 3. Embrace fractional shares. Invest like the big boys, even with small change. In the evolving landscape of investing, Buffett's third rule acknowledges the democratization of the market through fractional shares. He famously said, "The stock market is a device for transferring money from the impatient to the patient." Fractional shares have emerged as a means for even the smallest budgets to participate in the investment game, leveling the playing field. Gone are the days when investors needed a substantial amount to acquire a full share. With fractional shares, individuals can now buy slices of even the most expensive companies. This accessibility allows investors to own a part of their favorite companies, akin to buying a slice of pizza instead of the whole pie. Same deliciousness, less upfront cost. Buffett's endorsement of fractional shares resonates with the idea that financial participation should not be restricted by budget constraints. It aligns with his philosophy of making investment opportunities available to a broader audience. As he aptly notes, the stock market is designed to transfer money from the active to the patient. To illustrate the impact of fractional shares, consider the story of a young investor inspired by Buffett's principles. Armed with a limited budget, the investor leverages fractional shares to invest in renowned companies that were once financially out of reach. Over time, these fractional investments grow, echoing Buffett's mantra of patient and strategic thinking. Rule 4. The power of consistency. Small steps, big impact. Building wealth takes time and discipline. As Warren Buffett aptly puts it, the stock market is designed to transfer money from the active to the patient. Forget about sudden windfalls. Focus on the power of consistent, regular contributions. Even a small amount, invested regularly over time, can benefit from compound interest, growing your nest egg like a snowball rolling downhill. Buffett's wisdom aligns with the idea that success in investing, much like life, is a journey of small steps leading to big impacts. He emphasizes, "I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over." This perspective encourages investors to adopt a mindset of gradual progress, understanding that even seemingly small contributions can have a significant impact over the long term. Imagine starting with $10 a week. In a year, that's $520, and over decades, it can become a significant sum. This echoes Buffett's approach of consistently adding to your investments, no matter how small the amount may seem initially. He famously said, "The most important investment you can make is in yourself." Consistent contributions reflect a commitment to one's financial well-being, and over time, can lead to substantial wealth accumulation. Rule 5. Be a value hunter. Find diamonds in the rough. Buffett is known for his value investing approach, and his advice resonates with the concept of being a value hunter. He encourages investors to seek companies with strong fundamentals and potential for growth, but trading at prices below their true worth. As Buffett wisely puts it, price is what you pay, value is what you get. Don't just chase trendy stocks. Research companies, understand their value, and wait for opportunities to buy low and sell high. Think of it as finding hidden gems at a garage sale, not just buying the latest fad toy. This metaphor encapsulates the essence of Buffett's approach, the patience and discernment required to identify valuable opportunities amid the noise of market trends. He advises, the stock market is designed to transfer money from the active to the patient. Being a value hunter requires a keen eye, diligence in research, and the ability to see the true worth of an investment beyond its current market price. Consider the story of an investor who, inspired by Buffett's value investing philosophy, carefully analyzed companies, focusing on their fundamentals rather than short-term market trends. By adhering to this approach, the investor not only avoided the pitfalls of market speculation, but also built a robust and resilient portfolio. The lesson learned was not just about making profits, but about the wisdom of seeking enduring value in the ever-changing landscape of the stock market. Rule 6. Diversify wisely. Don't put all your eggs in one basket. Remember the fable of the 3 little pigs. Don't build your financial house on shaky ground. Diversify your investments across different sectors, asset classes, and even geographical regions. This helps spread your risk and mitigates the impact of any single downturn. Think of it as planting different vegetables in your garden, not just relying on one crop. Buffett's emphasis on diversification aligns with the age-old wisdom of not putting all your eggs in one basket. He notes, diversification is protection against ignorance. It makes little sense if you know what you are doing. Diversifying wisely involves understanding different investment avenues and strategically allocating your resources to weather various market conditions. Imagine your investment portfolio as a garden where each plant represents a different asset class or sector. By diversifying, you ensure that the success of your overall garden isn't solely dependent on the performance of one crop. This metaphor emphasizes the importance of spreading risk and building a resilient financial foundation. Consider the cautionary tale of an investor who, captivated by the allure of a single promising sector, decided to concentrate all investments in that area. When an unforeseen downturn hit that specific industry, the entire portfolio suffered significant losses. The lesson learned was a stark reminder of Buffett's advice: risk comes from not knowing what you're doing. Diversification is a shield against the unpredictable nature of financial markets. Rule 7. Patience is your best friend. Don't panic, stay the course. Market fluctuations are inevitable, but don't let them cloud your judgment. Remember, your long-term vision is key. Stick to your investment plan, avoid emotional decisions based on short-term swings, and ride out the bumps with patience. Imagine weathering a storm at sea. Stay calm, trust your compass, and you'll reach your destination safely. Buffett's philosophy on patience is encapsulated in his statement: the stock market is designed to transfer money from the impatient to the patient. Patience is not just a virtue, it's a strategic advantage in the world of investing. During turbulent times, the ability to stay the course and resist the urge to make impulsive decisions can make a significant difference in the overall performance of your investments. Consider the story of an investor who, faced with a sudden market downturn, resisted the temptation to sell off investments in a panic. Instead, guided by Buffett's wisdom, the investor maintained a long-term perspective, allowing the portfolio to recover and eventually thrive. The lesson learned was not just about weathering short-term storms, but about the enduring strength that comes from patience and a steadfast commitment to a well-thought-out investment plan. Listen, this isn't a get-rich-quick scheme. It's a marathon, not a sprint. Embrace the journey, learn from mistakes, and enjoy the process of growing your wealth, one small step at a time. As the great Buffett himself said, the most important thing to do is to not lose money. With these tips and a sprinkle of Buffett-style wisdom, even the smallest sum can unlock your inner investor and pave the way towards a brighter financial future. So, start small, dream big, and watch your tiny coins blossom into a financial forest. Remember, everyone's financial journey is unique. Consult a financial advisor for personalized guidance tailored to your goals and risk tolerance. Don't hesitate to seek professional help to navigate the intricacies of the investment world. By combining your newfound knowledge with expert advice, you can make informed decisions and embark on your path to financial success with confidence. Now go forth, young investor, and remember, even the smallest acorns can grow into mighty oak trees. Thank you for watching. Please like this video, click the notification bell so you will be notified when we upload another video. Also, comment and share your thoughts about this video in the comment section. You are blessed.